Yes,
256, 5.1.
5.1, page 6, okay, thank you. I'm a little slow.
Here we are into de facto control, by which I mean, set aside for a moment who the shareholders are. Are there any business or other relationships which cause one corporation actually to control the other? The purpose of this act, where the expression controlled directly or indirectly in any manner, whatever is used. So not just for the benefit of association and the small business deduction, it's for the purpose of this act. If those words are used elsewhere, and yes, they are. Corporations shall be controlled, considered to be so controlled by another corporation, person or group of persons, I'll skip some words, at any time where at that time the controller has any direct or indirect influence that if exercised would result in control in fact of the corporation. Except that where the corporation and the controller are dealing with each other at arm's length thus not related, and the influence is derived from a contractual obligation such as a franchise license lease, distribution, supply, or management agreement. I'll skip some words. The main purpose of which is to govern the relationship between the corporation and the controller regarding the manner in which a business is carried out by the corporation is to be conducted. So for example, if I have a Tim Hortons store, the franchisor, there are a lot of ways by which they can tell me what to do, and they should. The corporation shall not be considered to be controlled directly or indirectly in any manner whatever by the controller by reason only of that agreement or arrangement. So then what is, if a franchise or other similar contractual obligation doesn't result in one company being considered to control another, what might? Editorial note. Short answer, something like this is going to get litigated because honestly it's not specified clearly enough in the statute. Silicon Graphics case indicates that de facto control requires the ability to effect a significant change in the board of directors or its powers. Normally by clauses in the shareholders agreement, which those clauses are typically not part of the share terms themselves. They're usually a side agreement by which somebody says if something happens, I get to vote your shares or something like that. That's typically a scenario whereby 5.6 applies, and we get to skip over who actually owns the shares. Yes?
Would something like this apply if you are a director, if you or a group of directors in one corporation decide to invest in another corporation, where you're the shareholder of one, of the second corporation, but you have de facto control of the first? Because you are the board, so you do have control of the first corporation.
Is the first, just in case the camera didn't hear it, so got two companies and there are investors on the scene, and the investors have their own corporation, let's say, and there's a target corporation that the investors are investing in, but the investors themselves don't have control because they only own, let's say, 18% of the company that they invest in. But behind the scenes, there's a shareholders agreement that says that they actually have control or something like that, regardless of how many shares they own. That's de facto control.
Okay.
So regardless who the directors are, and regardless how many shares they own, the same people might control both companies, hence they should be associated. And the control is not by de jure control, it's by de facto control. Yes?
What kind of evidence are they going to look at to determine de facto control?
Well, good question. Agreements, certainly. My guess is that they look at correspondence among directors and executives as well. Honestly, not a provision that's used a lot by CRA. It's not one that would be used by advisors, because advisors are trying to disassociate companies. Only CRA would have value in invoking 5.1. It's rarely invoked, and CRA would honestly have to get pretty deep in the documentation weeds of the target company. But they might get tempted to if the target company seems to be invested in by, for example, angel investors who might want to exercise a lot of influence. And the angel investors, their corporation is probably bigger, in which case they want to suck up all the small business deduction for themselves. So your responsibility as lawyers is much like in the case we had earlier, like who's investing in my company and how many shares do they have, and tell me about their company. You're also trying to find out who's got influence where. And in some cases, the influence will come from agreements that you yourself have drafted.
Oh, there's a note under the 5.1 cases. B is a sole shareholder and director of one corporate taxpayer, and her husband K was the controlling shareholder and director of the other another corporation. The taxpayers were associated; they were both associated corporates under de facto because K had influence over the board decisions of B's company, even without owning any shares. So yes, so that if you have control over the board, not even in regards to voting, it's just that's de facto control. Oh,
Yep.
Cool.
Cool slash pretty scary, but yeah. And a paucity, I think that's the right word, of administrative pronouncements by CRA to go on, and a few and only a few court cases, unfortunately, because it doesn't get invoked very often. And I guess the fact that it doesn't get invoked very often is a good thing. Just repeating again, the 256, very powerful provision. Just while we're on the subject, if you look at 5.11 for a second, just for interest, the determination of whether a taxpayer has direct or indirect influence, I'll skip some words, shall take into account all factors that are relevant in the circumstances, which gets back to the point that if I'm CRA, I want to see emails and texts and everything, and want to know about discussions between spouses and all that type of stuff. As regards the Tabor Solids case. And not be limited to, and the relevant factors need not include whether the taxpayer has a legally enforceable right or ability to effect a change in the board of directors. Hence, part of the subject of the Tabor Solids control case. I'd like you to go to page 516, 516. This is an item for which there aren't yet any lecture notes. I will add some this week. Specified corporate income. can I get around this whole thing by, instead of having a shareholder relationship, so if I'm, this is me, my company, and I would otherwise want to be a shareholder of this company, but I'm going to be associated and I don't like that. Why don't I just earn a fee? You know, fee is income to me, or income to my corporation. Why doesn't my corporation just earn a fee from this corporation? And the answer is that for a lot of years, that was fine. In fact, CRA would give you an advance ruling binding on CRA, saying that that was no trouble, until 2 years ago the legislation got changed to say, look, if you try to get around these rules by earning a fee instead of being a shareholder of this company, we will look at the income that you've earned here and perhaps deny the small business deduction on it. And that's what this C is all about. The associated corporation rules place significant limitations on the ability to expand the $500,000 small business deduction limit, based mainly on shareholder-corporate relationships. But if we earn specified corporate income, we don't get to claim the small business deduction on this fee of, let's say, $100,000. Where one corporation earns income from providing services or property to another, property like a rental situation, that source income is specified corporate income, i.e. bad. If two types of conditions are present, there must be a certain relationship between recipient and payer, these corporations, and the recipient's income must meet certain threshold amounts. Conditions are described here. Relationship, specified corporate income may only occur if recipient corporation providing the service or property, or any shareholder of recipient corporation, or any person not dealing at arm's length, i.e. a relative of recipient corporation, has a direct or indirect interest in payer corporation. Notice there are no percentage ownership requirements that apply. Yikes. So any direct or indirect interest by any of the three parties listed is relevant. If the relationship test above is met, i.e. we're in doo-doo, then recipient's income from payer corporation will be specified corporate income if the income from payer is more than 10% of recipient's total active business income. So the Act says, look, we know that companies will earn service income from other companies. I get my car fixed at Crown Nissan, and Crown Nissan probably has customers that are corporations, and Stella's, if they have a Nissan van, they need their Nissan van fixed, so they'll take it to Crown Nissan, and Crown Nissan will charge them a fee. Nobody's saying that Crown Nissan should be denied the small business deduction relating to the profit from that fee. But if there's relationships or agreements or what have you, direct or indirect interests, the fee earned, the income they're on, would not be allowed for the small business deduction. Yes.
So in this example, if I'm if I have a small, electrician company,
Yep.
and I deal mostly with, corporate commercial, stuff, so I'm working in, office buildings,
Sure.
I go and, do, a bunch of work for some offices, and I find out that my brother
bought shares in one of those offices, now I'm screwed because all of my income is now specified? Because a non-arm's length, because a relative has a relationship with the client?
Yeah, I don't know the answer, but I certainly want to have a look at the rules to check. Yeah, that's exactly the type of scenario where the income earned from one company to another, unassociated, you have no interest in your brother's company, vice versa, that income might be tainted by these new rules. Here's where this actually came from. So before these rules came in, which again is only about 2 years ago, this is Frank Levitt.
The name was not changed to protect the innocent.
No. In fact, I wish he were here telling you the story. This is Taylor McCaffrey, and each of these partners has a corporation. And each of which has a $500,000 per year small business limit. And there's a rule that says that, which we're not into yet, but we will soon. If these corporations were themselves the partners, the entire partnership would only get one $500,000 limit. So if there's 1, 2, 3, 4, 5, 6 of them, they'd have to share $500,000. And so whatever 500 divided by 6 is like $90,000 or something. He said, we don't like that. So we won't make the corporations the partners. Each of us will be the partners. This is the symbol for partnership. And the partnership will earn a whole bunch of money. And the partnership will pay a fee to each of our corporations, including Frank Levitco, if that's what it's called. And each of those get a $500,000 small business deduction. And CRA, Taylor McCaffrey probably got a binding advance ruling from CRA saying that was legal, as it was until this rule, specified corporate income, came in around 2018. Each of them would get a $500,000 small business deduction. You should have heard the uproar when these rules got announced, because every professional, not just lawyers, but accountants and doctors and engineers or whatever, who worked in a partnership and therefore couldn't get the small business deduction except for their percentage share of 500 that the partnership had, said, okay, well that's fine, we'll just do this and charge a fee and we'll be fine. And their heads exploded in a big way. And honestly, I wish Frank were here today to talk about this, because I know he was pissed. And we do our new plans based on whatever the rules are today, and we just move on.
Is there a structure now that essentially accomplishes the same task? Or is that just like the good old days?
If there is, honestly, I don't know it. But I know that there are people who probably think about nothing else than how to get something like this back. So specified corporate income. And the purpose of that is to avoid a situation where we're getting a small business deduction that the Income Tax Act no longer feels is appropriate by way of paying fees. Please turn in the textbook to page 64. please turn in the Income Tax Act as well to subsection 248.1. 248.1. It's a definition subsection, and we're looking at the definition of business. Business.
I know. There's a lot of them.
So a business includes a profession, calling, trade, manufacture, or undertaking of any kind, whatever. I find a lot of redundancy there. I thought they just should have said includes an undertaking of any kind, whatever. But I guess those prefacing things add some color. And except for the purpose of paragraph 18.2c, which you don't need to know about, or those others, an adventure or concern in the nature of trade. Adventure or concern in the nature of trade, that's like day trading, where, for example, I buy things with the intent of selling them. People, for example, who buy cars at an auction and sell them in their driveway. So that's a business. But, and here's the important part for today, does not include an office or employment. So a business is defined as some activity, but doesn't include an office or employment. The small business deduction is so valuable that a lot of people hope they can get it based on what it is that they do. And they say, hey, like I'm active, I get up in the morning and I go to work. I'm not just investing or waiting on rent income or something like that. I work for my money. Surely I can qualify because what I do is no less active than someone who's running a retail store or something like that. Except that, unfortunately, 248.1 says that a business does not include an office or employment. So then we try to find out, well, what's meant by an office or employment? Page 64 is helpful. And it turns out that the Income Tax Act doesn't define it, so it doesn't define what is meant to be employed or to have an employment relationship. Fortunately, there's the whole whack of jurisprudence that helps us with 4 tests. Control test. If somebody tells me that I need to be in the classroom on Tuesday at 1 p.m., they probably have control over me that's consistent with an employment relationship. And by the way, relationship is the important word here. You'll see it like about 6 times in these paragraphs. Because it's not actually what the contractual obligations are or what the form is like. It's all about the substance. Control test, ownership of tools test. Actually on that one, somebody else owns my tools as well, like this computer and screen, indicating further that I'm likely an employee not carrying on business. Chance of profit or loss, I have 0. That is not a good indicator if I want to suggest that what I do is business. Integration test is my favorite because it's sort of the deepest and most cerebral. It's whether what I do is integral to what the university does. I hope that by being an educator in an education institution, that's integral. If, however, I am the person who waters the plants at the law firm, I'm probably not as integral to what that person does or what that firm does as if I am a paralegal. So if I'm the person who's watering the plants I might have a better chance of being an independent contractor, i.e. not an employee. And therefore, if my business is incorporated, I probably have a better chance of being considered as a business, according to 248.1 and the integration test. Because what I do is not really integral to what the business does. The business provides legal advice to clients. So I'll ask you to read these at your leisure and be familiar with them. There's something else that's very important here, particularly for lawyers. Let's see if I can find it. I can't quickly, so I will tell it to you. No, I won't, because it's immaterial.
Oh,
What I need you to know is that employment is about the relationship. It's not necessarily the form of the contract. It's what happens day to day, particularly as regards control and the integration test. I would call the others sort of important but junior to those two. If my corporation is performing services that, if I were not incorporated, would be considered as employment services, my corporation is carrying on what's called a personal services business. Please go to page 499. And this is bad. This is really bad. Like, this is worse than not being, pardon me, this is worse than being associated. And again, I gotta tell you that the lure of the small business deduction makes people think that they really wanna have a go at incorporating themselves and claiming it. And you as the lawyer, honestly, you should really try to discourage them if their facts are not good facts. And there have been a whack of court cases on this issue. The most important, or the most famous one of which, was that Revenue Canada, as it was in the day, took a CFL coach to court. CFL coach called Ralph Sazio, who I think in the 50s or 60s coached the Hamilton Tiger Cats or something. Took the position that he was an independent contractor and lost, and honestly he should have. Getting back to medical residents for a second. Doctors, particularly early in their career, usually have about 5 sources of income. Some of which are employment income and some of which are fee for service. And you as the lawyer, if a doctor comes to see you and says, I'm thinking about incorporating, need to understand what they do for each of those 5 sources of income they have and apply the page 64 tests by asking questions to see if they're in fact have an employment relationship or a business relationship. Because if it's found out that they actually aren't carrying on business in the context of 248.1, page 500, first full paragraph. A CCPC earning this type of income, i.e. personal services business income, is not eligible for the small business deduction. That's just for starters. In addition to that, it gets a special federal tax rate of 33%, not 28, but 33. So it's taxed at a higher rate than the Royal Bank of Canada. This is, you just never want to have your client in this position. and is not entitled to the 13% general rate reduction. And next paragraph, the deductions are limited to the same deductions that would have been available if the income were employment income. And I'm here to tell you that the deductions for employment income are this many. The deductions for being a commissioned salesperson or a corporation operating a business are this many. But the deductions for employment income is a very small list. Suffice it to say, if your client is trying to incorporate what is essentially employment income, according to those tests, control, profit or loss, ownership of tools, and integration tests, if it's employment income, please dissuade them from incorporating, or at least from running that income through their corporation, because the results are horrific. And there's, trust me, no planning way around this. This is just an awful thing. Now, there are some people that say, well, okay, look, paying 33% plus whatever the provincial rate is, yeah, maybe that's still less than, say, the 50% that I would pay if I'm in the highest bracket. Maybe I get a deferral of about 3 or 4%. Just not worth it. Yes?
So in what instances is a personal service business like applicable where you should actually use one of these things?
You should never use it.
Never use it? Okay.
Never, 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 ever. I don't like the title, by the way, personal services. It means like I'm a lawyer. I feel like or if I were a lawyer, I feel like I provide personal services. What it should be called is business that's really employment. That's what it should be. That's what I wish it were called. It makes me feel like if I'm a hairdresser, I shouldn't incorporate. That's not how it is. I should incorporate it, perhaps. But if I'm essentially providing employment services, I should not. Any questions on that? So in summary, no small business deduction, extra tax, crappy deductions. Page 497. Specified investment business income. Which I'll call SIB. So here we're talking about interest, rent, and royalties. In fact, those are the three I need you to know about. Interest, rent, and royalties earned by a corporation. Interest, rent, and royalties. No small business deduction, because it's not active. Government says, okay, look, we're trying to encourage people to incorporate their business and to start businesses. That's why we've got the small business deduction. The general rate, which is what we have if we don't qualify for the small business deduction, the general rate is only about 27% in total. Remember page, I think it's 428, where we had the integration rules? Yeah, it's 27%, sort of 15% federal and 12% average provincial. So if I'm earning interest income and I'm paying tax at the highest personal bracket, which is 50%, I'm thinking, I don't care about the small business deduction. I just want a taste of that 27% tax rate rather than the 50% that I'm paying as an individual. Government says, here's what we're going to do. We're going to charge you 50% corporate tax, thus discouraging you from incorporating to earn interest, rents, and royalties. At least don't incorporate for tax reasons. We're taking away all the tax reasons. But we realize that we have to when the corporation pays out the retained earnings someday, there will be double taxation because the individual shareholder will have to pay tax. So we'll do some kind of calculation to make you whole. And the calculation is an exhibit 13.3, which is on page 499. Just need a moment for this camera to warm up. $1,000 worth of, let's say, just interest. Keep it simple. Corporate tax at 40%. See off to the side there? 28% federal, no small business deduction. And 12% average provincial, total 40. 28 federal, no small business deduction. 12% provincial, total of 40. But wait, there's more. Government also charges so-called special refundable tax. And it says special, you think, well, that's a good thing, right? No, it's more tax. 10 2/3%. Total tax paid, 400 and 107 is $507. Approximately 50 2/3%. Which honestly is more than what I would have paid personally if I had just earned this interest income myself. And I went through the whole rigmarole of getting a corporation and everything, and I have to now pay $3,000 a year to file tax returns. So no one incorporates a company to earn interest, rent, and royalties. However, some companies will have this type of income because they earn active business income, and they haven't paid it out to the shareholders because the shareholder wants to enjoy the deferral. So the company reinvests and maybe earns interest income, and this is how the tax applies to that income, 50.7%. I'm saying my company's paid 50% tax. What happens when a dividend gets paid to me? This is not an eligible dividend. It's not an eligible dividend. I have to pay tax on it. The government gives some of the tax back to the corporation. The government gives back to the corporation $307, thus making available for me $800 as a dividend. The corporation only gets the $307 when it pays the dividend, which might be in year 2 or 3 or 5 or 100. Gets $307 back. I get $800, and I pay full up tax on it of $344, thereby leaving me with $456. Me being left with $456 involves a tax rate of 54%. My tax was $540, 54% of $1,000. So I didn't go into this on purpose to earn interest income, but my corporation is, and this is how it gets taxed. And my corporation honestly overpays, but I'm still happy to leave the money inside the corporation because I don't want to pay personal tax until sometime down the road. I want those 91-cent dollars growing by earning interest income. The mechanism they chose for this is, it would have been simpler if they just said, hey, look, we'll just charge you 5% on your dividend or something. They said, no, we'll charge you regular dividend rates, we'll just give some money back to the corporation. This is how it works.
Are those refunds split between the two types of corporate tax? right? Because the corporation is going to pay federal and provincial separately. So do those dividend, the dividend refund, do those come split from, or do they come only from the federal, or how does that work?
In case the camera didn't hear that, the question is the 307 dividend refund, is that a federal thing or a provincial thing or both? It's all federal.
So in this particular example, the federal government is giving back more money than they took.
In this example, the federal government took 28% and is giving back 32/3. That's correct. Yep. It's like the carbon tax credit. I'm joking. Why does the federal government do this? Because they know they're going to hold on to that 28% for a long time. Because people don't want to receive dividends personally. So the government earns interest on the 28% for the 10 years it takes before I finally pay out the dividend and the corporation gets a dividend refund. It seems counterintuitive, but in some way it makes fiscal sense. The refund is limited to $38 2/3. This, don't even write this down, but it was a question asked on the Q&A page, so I'm going to answer it. It's limited to 38 2/3% of another side calculation, something like GRIP, that the corporation's accountants do every year. And somehow that 38% sort of agrees with this 30 2/3 and a couple of other things, and that's all you need to know. So what you need to know is that there's a rule that says a corporation, and this is only about CCPCs, by the way. CCPCs earning interest, rents, royalties actually pay a little bit more tax than if the income were earned personally. Thus, we don't incorporate to earn this type of income. That would be a bad decision. But corporations that do earn this income, because maybe they've got retained earnings from their active business, get taxed thusly, and the corporations overpay tax but get a refund later on when they pay a dividend. And the shareholder, individual shareholder gets the dividend, pays regular individual dividend tax on it.
Does that happen even if, like, for example, your corporation is designed specifically to rent buildings? Right, where that's your general, that's your purpose? Or if you're, again, if your purpose, if you're a loan company where interest is what you do.
Turn to page 497. Item 2, other property income such as interest, royalties, and rents from real property is considered to be active business income if the corporation employs more than 5 full-time employees doing that. So in answer to your question, it's not whether it's sort of the primary thing of the corporation, it's whether the corporation's activity is so active that it employs the whole whack of people full-time. If it does, now it's active business income, and this goes away. SIB income is also deemed to be active if it's earned from an associated corporation. If I've got 2 corporations, both mine, both associated, one pays interest or rents or something from one to the other, if it's deductible from the active business income of this corporation, it's active business income to this one. And for that, I'll ask you to turn to 129 bracket 6, and that will end it for today. One, two, niner bracket 6. Where any particular amount paid or payable to a corporation by another corporation with which the recipient corporation was associated would otherwise be included in computing the income of the recipient for a particular year from a source in Canada that is property, for example, interest or rents. Instead, for the purpose of the rest of this, it'll be considered not as property income but as active business income. So if it's paid from here, pardon me, if it's deductible from the active business income of an associated corporation, it's okay to call it active in the hands of the corporation that earned the income. We have a quiz in next class, and I will let you know by this time tomorrow what will be covered in the quiz. Short answer, probably everything we've taken to date, but I'll have a look and see if there's anything I should delete. Thank you and have a good night.